Section 1. Fundamental Economic Concepts. It is not from the benevolence of the butcher, the brewer, or the baker that we expect our dinner, but from their regard to their own interest. We address ourselves not to their humanity, but to their self-love, and never talk to them of our own necessities, but of their advantages. Adam Smith, An Inquiry into the Nature and Causes of the Wealth of Nations. Economics is about everyday life, about the choices each of us makes, and how these choices affect our neighbors, our community, our nation, and our world. Looking at these choices from the perspective of economics helps to illuminate hidden wonders in the everyday world around us. For example, the next time you stop at your supermarket to pick up a loaf of bread on your way home, pause for a minute to reflect on your surroundings. If your supermarket is like the most, there will be rows of fresh produce, aisles of baked goods, shelves full of laundry detergents, cases of frozen foods and dairy products, and other items. In fact, the average supermarket carries about 31,530 different items. That each of these items on the shelf is a result of a complicated chain of reactions of decisions made by almost uncountable number of different people. For example, for a loaf of bread to reach the store, a farmer has to decide to grow the wheat. A milling company has to purchase the wheat and grind it into flour. A bakery has to purchase the flour alongside other ingredients and then combine them to produce the loaf. And finally, the perishable product has to be delivered in a timely fashion to the store. Each product have a similar story. When you go to the store, you expect to be able to find the bread and all other products your supermarket carries. But what ensures all of them will be there, as they almost always are? No one ordered the farmer to grow the wheat or the baker to bake the bread. They don't take these actions so you could pick up a loaf of bread on your way home. They did what they did because it was in their own best interest, yet somehow, almost magically, all of these individual choices were coordinated so that when you arrive at the store, there is an entire aisle of different types of bread available for you to choose from. Now step back and consider the fact that the store you are in is only one of the thousands of supermarkets across the country, and that supermarket is only one of many millions of business that make up our economy. Many people will take all of this for granted, but as the example of less developed countries around the world makes clear, there is nothing automatic or inevitable about how well our economy functions. Economics can help us understand both why our economy functions smoothly most of the time and why it occasionally breaks down. Basic assumptions of economics. Economics is a study of how individuals make choices about how to allocate scarce resources in order to satisfy virtually unlimited human wants, and about how individuals interact with one another. While economists study a vast range of different behaviors, their work is unified by their reliance on a few seemingly simple yet remarkably powerful assumptions. Scarcity. Scarcity is an inescapable fact of human existence. There are only 24 hours in a day to devote to work, study, play, sleep, and other essential activities. No matter how wealthy a society is, the amount of work, energy, knowledge, and capital available to produce the goods and services people wish to consume is limited. On the other hand, our desire is insatiable, just as families must choose how much income to spend on food, clothing, vacation, travel, and savings for retirement. Society face choices about how much of their resources to devote to healthcare, national defense, and education. Trade-offs. Scarcity implies that every choice we make requires us to give up something to get something else. If you decide to spend an hour watching television, then that is one less hour you have available to study. Similarly, if you choose to spend $10 to go to a movie, then you have $10 less to spend on video games or to save for college expenses. Every choice involves multiple trade-offs. You could also spend $10 on food, socks, or friendship bracelets. Economic thinking involves evaluating trade-offs in order to make the best choice for your self-interest. Opportunity cost. The cost of what you choose is what you have to give up to get it. Economists call what you give up the opportunity cost of your choice. In the simplest terms, opportunity cost is the value of the next best alternative, trade-offs to the choice you have made. It is important to note that the opportunity cost is not necessarily the same as the monetary price you pay. For example, suppose a friend offers you a free ticket to a baseball game. You may not have to pay for the ticket, but the opportunity cost of attending the game is the value of what you would have been doing during the time if you had not gone to the game. For example, if you had been planning to work mowing the lawns, the opportunity cost of this choice is the income from mowing that you would forego by attending the game. Opportunity cost is a seemingly simple concept, but applying it can sometimes be rather tricky. Consider the cost of attending college. It might seem obvious that the cost of attending college is the sum of the price, tuition, books, room, and board, but this answer excludes an important cost of attending college. For most people, the biggest cost of attending college is the value of their time. By choosing to attend class and do homework, you are giving up the time that could otherwise be spent working for pay. At the same time, the explicit monetary cost of attending college may overstate the true expenses. Even if you did not attend college, you would still need to eat and have some place to live. Thus, the cost of room and board are not really part of the cost of college. Rationality. Economics assume that people make choices by comparing the benefits of each action with the opportunity cost of that action, and then selects the action that produces the greatest benefit. It is important to note that the benefits can be interpreted broadly. Many people care a great deal about societal issues, such as reducing pollution or helping those less fortunate than themselves. Such concerns are entirely consistent with the rational decision-making or rationality. Most of the time, people perform this cost-benefit calculation intuitively and approximately, in the same way that a basketball player does not stop to calculate the physics behind the perfect three-point shot. Rational people acquire a feeling of what the cost and benefits of their actions will be, just as some of us are better at hitting three-point shots than others. We're not born with the ability to infallibly calculate the cost and benefits. One of the rewards of studying economics is that it helps us to become better decision makers. Gains from trade. An individual differ in the ability, interests, and resources. As a result, we are all better at and get more pleasures from some activities than others by specializing in the things that we like to do the best and then trading with other people who have different abilities. Both we and they can then be better off. As long as the exchange is voluntary, then the benefits must outweigh the cost for both of the people involved. Models and economic theory. Economic analysis relies on careful observation, description, and measurement of economic activity, but it also relies on theory. To understand how the economic phenomena we observe fit together, it is necessary to build theoretical models that capture the essential features of these interactions while stripping away the unnecessary details. Models comes in a wide variety of forms and can be expressed in many different ways. In economics, models most often consist of diagrams or mathematical formulas. At first glance, many of those models may appear hopelessly simplistic, but the test of a model is how well it captures aspects of reality that we are seeking to understand. The simplicity and the lack of realism of many of these models is what allows us to identify so clearly what assumptions and characteristics are important. Positive and normative economics. The insights that economics offer about individual and societal decisions can be used in two ways. Positive economics uses the tools of economic analysis to describe and explain economic phenomena and to make predictions about what will happen under particular circumstances. It focuses on identifying cause and effect relationships and measuring their size. For example, positive economics tells us how much we might expect the consumption of gasoline to decrease when the price of gasoline increases. In this sense, positive economics is essentially value-free. It does not require that economic analysts express any opinion about the relative merits of different choices. Normative economics is the term used to describe the use of economic analysis to guide decision about what should be as opposed to what is the case. Normative economic statements combine economic analysis with value judgment about relative merits of different possible economic outcomes. The tools of economic analysis, such as cost-benefit comparisons, can help to structure a discussion of different possible outcomes, but the choices between the outcomes usually require us to refer to criteria beyond the scope of economic theory to justify our particular choices. To better illustrate this, let's consider the debate about whether to increase minimum wage. Positive economics can help identify the ways in such an increase would affect different groups as well as provide estimates of their size. In addition to recognizing that a hike in minimum wage would increase the income of the workers who hold minimum wage jobs, it is important to note that higher wage may result in some minimum wage workers losing their jobs. Moreover, others who are seeking employment in jobs covered by the law may be unable to find employment. Finally, employers who have to pay higher wages may see their profits diminish, and they may pass some of the cost on to the consumers, who will see the prices of goods and services that depended on minimum wage workers increase. As this list suggests, an increase in minimum wage will benefit some people and hurt others. To decide whether the benefits outweigh the costs require a value judgment about the relative ranking of these effects on different groups affected by legislation. Efficiency as a goal. An important criterion that economists often apply in evaluating a society's use of scarce resource is the efficiency of the resulting allocation. Given any particular outcome, economists would say that it was efficient if there is no way of improving at least one person's well-being without reducing the well-being of someone else. This criterion is called Pareto efficiency, after the Italian economist Vilfredo Pareto, 1848 to 1923, who was the first to make use of this concept. Notice that the Pareto efficiency can characterize a wide range of different economic outcomes. Consider, for example, an economy with 10 people that produces $100 worth of goods and services. If each citizen receives $9 of benefits and $10 of the production is wasted, then this outcome is not Pareto efficient. Redistributing the $10 will make at least some of the citizens better off without making any of them worse off. On the other hand, a situation in which each citizen receives $10 is Pareto efficient. There is no way to increase the well-being of any citizen without reducing the benefit of another. However, an outcome in which one citizen receives $91 of income and each other 9 receives $1 is also efficient by Pareto criterion. The only way to make anyone better off is to redistribution. Pareto efficiency does not provide a basis for choosing between these alternatives. Efficient distribution of benefits. Which distribution is best is, from the perspective of economic analysis, a normative judgment that rests on the criteria outside of the realm of positive economics. While economic theory does not provide a basis for such choices, economists often offer such value judgments along with their positive analysis. Despite this limitation, efficiency is an important first step in maximizing overall well-being. When we make decisions about how to allocate resources, it is important that we do so in a way that does not waste any of them. Microeconomics and macroeconomics. The tools of economic analysis can be used to study a wide array of phenomena, ranging from how individuals and businesses make decisions to how they interact in markets, on up to the factors that determine the overall level of production, employment, and the price level of national economies. The field of economics is traditionally divided into two broad subfields, microeconomics and macroeconomics. Microeconomics concentrates on individual behavior and the operation of particular markets. Macroeconomics concentrate on the overall performance of the national economy. Clearly, microeconomics and macroeconomics are closely linked. They share common assumptions about the basic features of human behavior, but because they focus on economic activity on different scales, different aspects of this behavior are important, and their models of analysis are sufficiently different, so it is useful to consider them separately. End of section 1.